I die, I can't hide what this is. Yeah, I keep drowning in those blue eyes, and you can tell me all of your lies. I will put out all of the fire if it gets too dark. I'll be your light. Be your light. I'll be your light. If it gets too dark.
Good morning. Welcome to BST Live. The music was just getting into the good part there, so sorry we had to cut it. But welcome. We're going to be talking today to our guest. He's going to be sharing with us how to increase returns using performance qualifiers. So let's get to it. Oh, good morning, good afternoon, good evening, wherever you are. Glad you could join us today. It's nice and early here in Melbourne, 6 a.m. for me. So I'm still waking up. The coffee is kicking in. So I think we're going to have a great show today. Glad you could join us. G'day, Joshua. Thanks. Looking forward to a great session today. So yeah, me too. So as I mentioned at the start, we're going to be talking about how to increase returns. And we're talking to a special guest who has been on the show before, actually. That special guest is Tomas Nesnidal. Welcome, Tomas.
Good evening, everyone, and good morning, good afternoon. Thank you very much for having me.
Excellent. So you're, as I mentioned, you've been on the show before. We've talked about breakout trading and market internals, but for people perhaps who haven't seen those episodes or haven't are not aware of you and your work, can you just share a little bit about your background in trading and how you got started?
Mm-hmm. So I've been a trader for more than 15 years now. For the last 10 years, I've been a full-time algorithmic trader. My specialization is breakout strategies. I'm a full 100% breakout strategies, automated breakout strategies trader. And since last 4.5 years, I'm also running my private hedge fund. So I don't know if that's enough or if I should add something else.
No, that's perfect. So can you explain why you decided to specialize in breakout trading? Like why that style in particular?
That's a brilliant question. So I basically went through a lot of different types of trading, and I started as a discretionary trader about 15, maybe even 17 years ago. And then, when I was getting older and older, I realized it was not for me. I wanted to move to algorithmic trading for the decision making on the computer. And I started with really trying different approaches, different styles of trading. And then a friend of mine from Czech Republic, I'm originally from Czech Republic, but I've been living in Spain for a while. And he shared with me some breakout trading concepts, and he talked to me about how algorithmic trading, algorithmic breakout trading works. And, it just something clicked. And I was like, wow, man, that's it. That's what really resonates. That's what perfectly aligns with my nature and with my understanding of markets. And then I basically decided to become a breakout specialist. I think I went deeper into breakout trading than most of traders living out there. And I know it's not a modest thing to say, but I've been really very, very deep into breakout trading. And as I said, it basically, the peak of my career was launching my own hedge fund, private hedge fund, which is running 100% breakout trading strategies.
Yeah. Okay. Thanks for that introduction. I just noticed actually we had a problem streaming to YouTube. It's started up now, but there was a little bit of a delay. So apologies to everyone on waiting there. But just a quick summary then, we've got Tomas Nesnidal here today. He's a breakout trading specialist, hedge fund manager, and we're going to be talking about increasing returns using performance qualifiers. So if I can just get a quick hello in the chat just to make sure that it's all working now, that would be great. And apologies for that little glitch at the start there. So, as I mentioned earlier, which nobody caught because it wasn't streaming properly, you've been on the BST podcast before. We did a couple of episodes. You shared. Okay, we're getting a lot of hellos in the chats now. So thanks, John, Thomas, Joshua, Eheim. Thank you very much. Excellent. And Stephen's here as well. So we're all running fine now, Thomas. Apologies for that technical glitch. So now you've been on the show before. We talked about breakout trading. That was a very popular episode, actually. You shared your model into building breakout trading strategies. You were also on talking about market internals, which is a very interesting topic. If you want to, if anyone wants to see those, just head over to bettersystemtrader.com and you can do a search for Thomas and you'll find those. Now, today we're going to be talking about, I think, one of your most interesting concepts, because obviously I've been following your work and we do some things together as well outside of this. But I think this topic is something that maybe traders don't fully understand the power of it. I think sometimes traders tend to be a little bit conservative with some of their approaches. I think this one is a really powerful approach, which you're going to be sharing today. So it's DPS. Can you explain a little bit about what DPS is?
Right. So DPS stands for dynamic position sizing, and to me, it was really a breakthrough thing. It's a completely new way of looking at position sizing, and it's a proprietary thing that we're using in our hedge fund as well. And I think it's a big part of the success. It basically, the idea of dynamic position sizing comes from something that I believe that very few traders realize. And it's got something to do with a very, very popular trading metric, which is win percentage. And, a lot of traders, when they got into trading, they are pretty much concerned about what their win percentage is. Like, am I winning 50% of time or 70% of time or 40% of time? And then, of course, it gets more complex because we also need to include reward risk ratio and put these two elements together to calculate our probability and how much money we can make. But, the thing is that a lot of traders, especially at the beginning, they're very focused at this metric of win percentage. And the thing is that most traders, they see it as something static. Like they get their backtest report, and the backtest report say, well, 50% or 51% win percentage. So the trader says, I have 51% of time winning trading strategy. But what they do not realize is that, this number is pretty false. It's a very unreliable number, because the truth is that win percentage fluctuates, and it fluctuates quite a lot. I mean, like, just get your backtest history shifted by 1 or 2 years, and you'll get completely different number. Or what you can also do, if you use TradeStation like I do, then just go to the part of the report where you can see breakdown of every single year, and you will see that each year you have a completely different win percentage. One year it can be 70%, the other year it can be 30%, and on average it can be 50%. But how it's a different thing to say it's on average 50, and it's a different thing to see that you're sitting entire year on 35% probability when it should be 50. And you're wondering why you're not making money. And that's just because a lot of traders, they do not realize how much this value fluctuates. And I personally got pretty fascinated by this, because so many traders, they are all about win percentage as one of the most important metrics. And I was like, how can we even work with this reliably when it fluctuates so much, when it's such an unstable number, which can really give you such a false perspective of your trading system. And the more I started digging deeper into this win percentage, the more I started realizing that maybe it's not a disadvantage. Maybe it can be turned into an advantage. And that's where the concept of dynamic position sizing got born.
That's very interesting. I think actually you've prepared a couple of slides to demonstrate the concept. So let me just, I think we've got a slide that explains that. Let me just put that one up on the screen here.
Right.
Okay,
so this is just a very, this is quite an arbitrary example, but you can make with your own strategies plenty of examples like this. So basically, you take a simple strategy. This is a modeling example where you have some average win, average loss, you have some reward risk ratio. And then what you really do, you have, let's say, 100 trades sample size. And on average, you have a certain win percentage. But the truth is that when you break down these trades by 10, so you look at a win percentage of trade 1 to 10, 11 to 20, and going on until the 100 trades, you can see quite often a picture that is on the right side when you can really see how much there's a fluctuation of win percentage. So now the question is, what really is your win percentage? Because you might think that your average win percentage is, for example, 50%. But when you see a chart like this, what is the truth? Well, the truth is that your win percentage is nothing but 50. Your win percentage is actually a fluctuation of certain range between 40 to 60 or 30 to 70 or whatever the number is. And that's what we need to do. Like, we need to start modeling this more realistic number, this number which really gives us some idea what win percentage is. And when we start breaking this down and we see how much it fluctuates, then we can start asking some serious question. One of that question, as I said already, it got me into dynamic position sizing. And that question was, okay, so what would happen if I could literally change my position size with the fluctuation on the win percentage? What I could go zero, even zero contracts or one contract when it's on the very low edge. What would happen if I would go my normal position size when it's about average? And what would happen if I would go higher with my position size? And I mean, even two contracts instead of one. Doesn't need to be anything fancy. And what would happen if I would increase my position at this high level of the win percentage fluctuation? So you basically can take your win percentage fluctuation, split it into three parts, and then start doing a dynamic position sizing between 1 to 3 or 0 to 2 contracts. And all of a sudden, I saw incredible results. What really happened when I started modeling this idea, I saw immediate improvement of net profit versus drawdown ratio, like a huge one. You can have a strategy which initially starts with a net profit drawdown ratio, let's say 8 to 1. You apply dynamic position sizing a simple way like this. All of a sudden, you jump to net profit drawdown ratio 12 to 1 or 15 to 1. You increase your profit very often with even lower drawdown. So you can make more money with lower drawdown. You increase your average trade. And all of a sudden, without a single change of your underlying logic of your trading system, you start seeing some tremendous improvements, very fast, very powerful improvements. And that's how I got into dynamic position sizing, because I really realized that we can use this phenomena of fluctuating win percentage. And if we craft a way to really use that in our advantage with very simple variability of position sizing, we can get terrific results without touching the underlying system.
Yeah, that's it's an interesting concept. I know we're going to dig into the application of that a little bit deeper. Just got a question in the chat here, or maybe a statement from Amir. I'm just going to put this up on the screen and ask you about it. One sec. Here we go. In your experience, Tom, is the win percentage in itself mean reverting?
Well, it depends. It depends at the moment when you look at it. It could be, but it's not like rule, because your win percentage range can really make new highs and new lows, like your equity curve. So you start with certain range, and you think it's mean reverting, but it's not just mean reverting, it's also expanding, because after 3 or 4 years, you can reach a new level of win percentage on the high side and another level on the low side. So it's expanding, or it can be moved slightly upwards, the whole range. So yeah, there is a component of mean reversion, but it's also expanding. Sometimes it's contracting, and it's moving. It's constantly moving its entire form. The expansion, the contraction, and part of that it's mean reversion as well. Yeah.
Yeah. Okay. So before we dig into it a little bit more, I just want to ask: is this like trading the equity curve, or similar to trading the equity curve?
No, it's got nothing to do with equity curve. Like equity curve, trading equity curve, it's a concept that I spent a lot of time with, never worked for me. I never achieved any success with that. That means the way I apply dynamic position sizing, it's got nothing to do with actually monitoring win percentage and drawing some bands around it and calculating mean reverting. This kind of trading and position sizing didn't really work for me ever. I just explained this to understand the concept, but the way I apply it, it's different, because I did a lot of testing, a lot of approaches. I really spent a lot of time trying to figure out how to get most of this phenomena, and it has to be done differently. It cannot be done like this typical equity curve trading or just watching the win percentage, how it's moving, and then it needs to be more sophisticated than that.
Yeah. Okay. So let's dig into a little bit more then on how this is different, because I think the term dynamic position sizing has been around for a while. I'm not sure it's hit mainstream. I haven't seen a lot of stuff on the internet about it, but there's some things out there. So how is what you do different to that?
How it's different than normal position sizing?
Yeah.
So this approach, so the classical position sizing basically, and that's what I think it's, from my perspective, not enough, especially in today's markets, is that classical position sizing only relies on your equity curve. So you're basically tracking your equity curve, your account, if we want to simplify it, and based on an increase or decrease of the money on your account, you're either increasing or decreasing your position size. So the more money you are making, the more you can afford to increase your position. The less money you're making, or the more in drawdown, the more you need to reduce your position, which is all fine. It's all logical, but it doesn't really take into account one important component, and that component is what markets think about it. How is this interconnected to markets? Because you can be at the very top of your equity curve, and you might think, based on your classical position sizing method, that now it's the time to double your position. But markets can be in a perfect constellation for massive mean reversion in times when you rely on breakout trading or momentum trading. So that means you basically will double your position at the worst moment you can, and you will start facing very steep drawdown, very steep decrease of your equity, of the money on your account. And that's, I think, where we need to stop being conservative. We need to step outside. We need to start thinking outside of the box, and we need to think, how can we connect the idea of position sizing in a way that it also aligns with what's really going on with markets? How can we connect these two things together and do it dynamically, based not only on your equity curve, but also on what's actually and really going on in markets, so it's fully reflected and you're not position sizing at the very worst moment you could.
So is that where this term performance qualifiers comes into it?
Yeah, exactly. So in our hedge fund, we named these, we So these techniques, as I already explained, it's not based on equity behavior. It's not based on your equity curve. It's based on what's actually going in markets. And we came up with with a couple of ideas how we could really assess what's really going on in markets on a holistic probabilistic scale. And based on that, we would know exactly if the win percentage probability of the next trade is on the lower end, higher end, or middle end. And then we came up with a term of performance qualifier. So what really is a performance qualifier? So performance qualifier is a method where before entering the trade, there's a certain qualifier which really assesses the overall market situation and tells you whether your probability of next trade is on the lower end of the range of win percentage, on the higher end, or it's about the mid-range, the average. And based on that qualifier, you know exactly if your next trade should be 0 or 1 contract, or 2 contracts, or 3 contracts, or any multiplier of that. So it basically pre-qualifies the market or qualifies the market condition. It qualifies the entire market structure and situation. And then it tells you what is your actual probability on your next trade within this range, because it's not 50%, it can be 17 or 30. And it will tell you how to react based on that information, how to position size based on this.
Yeah, okay. So I've got a couple of questions in the chat about how to apply this. Can you perhaps give us an example of what a performance qualifier is?
Mm-hmm. So first of all, let me explain that performance qualifier is not a filter, because the difference between a filter and performance qualifier is that filter is binary. Filter is something that either is 1 or 0. You either use it or don't use it. It either tells you go to the trade or it tells you hold back from that trade. Performance qualifier is a qualifier which got more states than just 0 and 1. It's not binary. So it can give you different probabilities based on different pointer in markets. So for example, a very, very simple example. This is like reduced example just for the sake of explaining the concept. But a lot of traders, they use and I'm one of them, as a filter, they use, let's say, the relation between yesterday's or previous days open and close. So whether your close was lower than open or higher than open, based on that, you have a certain probability that the next day will be either up day or down day. And these are easy statistics to track, and these can really be pretty powerful and reliable statistics. However, this is a filter function. This is a filter mentality. Qualifier, performance qualifier, will do a more holistic assessment of that relation between yesterday's open and close. It will take into consideration maybe how far it is, or if it's between some high or low or within some range. So it performs a more holistic statistical probability assessment, and it will tell you, and it will work with non-binary outputs. So usually you will have at least 3 outputs, and it will, we call them ranges or levels. So you will have level 1, 2, and 3. And you know that in level 1, you have the lowest probability of success for the next trade. In level 2, you have average probability. And in level 3, you have the highest probability for your next trade. And based on that particular level, where your close really is, the previous day's close is, you have multiple scenarios for different position sizing. And then you dynamically position size based on that information.
Yeah, okay. Got a question here in the chat, which I think you may have just kind of touched on a little bit, but I think we should clarify this one. So let me put this up on the screen. It's from Sinan, I think. Apologies if I mispronounce that one. How can you arrange DPS or decrease position sizing after lower percent or higher win percent? Because you see the win percent after it occurred. Do you get any measurements for repainting?
Well, I think I just replied that I do not care about win percentage at all. I just use it as an example. All I know that win percentage is fluctuating, but I think I need to clear this again. I do not do what I do not do is I draw a win percentage and then I see, okay, now we had a higher win percentage, so next trade will be probably low percentage because of mean reversion qualities or whatever. I do not care about that win percentage at all. All I know that I have a system with fluctuating win percentage. And sometimes the more of a fluctuation, the better. And now I'm asking question, what causes that fluctuation? And nothing plot on the equity curve or nothing plot on the development on your win percentage history has anything to do with that fluctuation. What has got to do with that fluctuation, it's market condition. Because it's market condition which will tell you whether next couple of trades you will be on the lower side or higher side or around the average. So performance qualifiers, it's a method that assess the market condition and will tell you the probability that your next trade will be rather on a higher or lower or medium level of this win percentage fluctuation. So we do not care about this win percentage information whatsoever. It's all about the market context. And based on that market context, we know that it will have different outcomes because we saw that in win percentage fluctuation. So it's been confirmed. We know that this is going on, this is happening. And what we did, we just figured out what are these qualifiers which have the biggest impact on win percentage. And based on that, we can predict the probability of next trade and position size accordingly.
Yeah, okay. Well explained. Thanks for that, Thomas. Hopefully that answers your questions, Sinan. We've got a question here from Joshua, which leads nicely into what I was going to ask you next. Let's put this one up from Joshua. So he's talking about the types of performance qualifiers. He said, in this question, he said, it sounds like you're talking about market volatility-based sizing, but then in a second question, which I won't put up on the screen, he's talking about market regimes like bull and bear and high and low vol. So can you explain a little bit more about the types of qualifiers that you use yourself and in your hedge fund?
Yeah, right. This is a brilliant question, Joshua. And you know, I like that you're already thinking this direction of volatility, because in one thing, you're completely right. Like volatility assessment is definitely one of the ways how to create very powerful performance qualifier, which will tell you what are different states of markets delivering different probabilities. So this is very right direction. This is how it really works, because volatility definitely is a powerful performance qualifier. However, in our hedge funds, we realized that it worked for some type of strategies and markets, and it didn't for others. So we didn't know what to think about it. We didn't know what to do about it, because you really want to use this phenomena. And I already said that it can tremendously improve your results with pretty much very little effort. So we really were trying to figure out what was going on, why volatility doesn't apply universally, doesn't work universally. And we started digging deeper, and we realized there are more ways to assess markets. So again, as Joshua said, Joshua said, Tom, you first mentioned volatility, then you mentioned market regime. Because sometimes it's volatility for certain strategy or approach, trading approach. For some other one, it can be market regime. So we really spent a lot of time trying to figure out these qualifiers, and we basically reduce them into a couple of areas. And we use right now we use 4 or 5 different groups of qualifiers, performance qualifiers, and we have different techniques in each group. So we use a concept which we call market contraction expansion, because that's a very powerful qualifier. Markets are constantly expanding and then contracting, and based on this configuration, the win percentage changes a lot. Probability of next trade changes a lot. Then we use a concept of market strength, because market strength is another very reliable phenomena that is highly related to win percentage. Then we used volatility based, exactly as Joshua suggested. That's a powerful one as well. Then we use market internals approach, which is like an independent, very powerful approach as well. And then we use time-based approach. And each of these approaches got its powers, and some of them work for more markets and systems, some of them for less of them. But in general, for every strategy or any market approach, you can apply at least one of these 5 approaches, and you get pretty reliable and very, very fast results when you use these qualifiers and change your position size.
Okay. Thanks for that explanation, Thomas. So earlier you touched upon how you use this to adjust the position sizing. Can you go through that a little bit more? So you're using these performance qualifiers to identify if the next trade is a higher probability potentially than lower. But then what do you do? What are you doing with your position size then?
Well, it's pretty easy, because what we really do, like with our performance qualifiers, we always have only 3 possibilities. The output can be 1, 2, or 3. 1, it means that there's lowest probability. 2, it means that it's average probability. 3, it means highest probability. What we do in our hedge fund, we have some default position, which can be, let's say, now just for an example, 100 contracts, but that applies for the second for the situation when market qualifiers says 2. When it's number 2, we go with the typical position size. When it says 3, we can double, like go to 100 contracts, and when it says 1, we can go half, just 50 contracts. But what I need to say, and this is very important, like a lot of traders think that position sizing, especially beginning traders, they think like position sizing, I'm not there yet, it's not for me. And that's a very, very limited point of view. I would even say it's a wrong point of view, because don't forget that you can also, and TradeStation allows that, you can literally quote unquote trade 0 contracts. That means that your strategy, your signal will not be executed. So what you can really do, let's say you are a beginner trading with 1 contract. Well, then don't trade with 1 contract, but trade with 1 contract on average, which means that sometimes you will have 2 contracts and sometimes you will have 0 contracts. So on average, you will keep trading your 1 contract, but be smart about that average 1 contract, rather than putting 1 contract everywhere where, like, flat default situation position. Just be smart about that. Like when the odds are really, really on your side, double that position to 2 contracts. And when the odds are really, really low, just skip that trade, because why would you want to be in a trade with more than way lower than normal probability of win? So you see, you're still on average trading your 1 contract, but now you are way more smarter and you're dynamically changing your position sizing based on your upcoming probabilities, and you can get way more money from your strategy, and often even with a lower drawdown.
Yeah. So what about the risk side of this then? So if you've determined that you're in a high probability environment and you've you doubled your position size or you've increased it, there's still no guarantee that's going to be a winning trade, right? It could still be a losing trade. So does that actually increase your risk? Can you be prone to larger losses and larger drawdowns because you're doing that?
It depends because, so first of all, not necessarily. It's quite surprising, but once you start testing this concept and seeing the results, it's really surprising that you can improve more often than not your net profit without increasing your drawdown. And that's because you're skipping some potentially very low probability trades. So you're not necessarily having or experiencing higher drawdown because of that. When it comes to risk, it's a more complicated question, because the thing is that with certain performance qualifiers and in certain market conditions, when you have a different probability, what really changes as well is your maximum reverse excursion. That means your pullbacks can be lower. So it even means that in certain situations, which again, performance qualifiers tell you very exactly which situations these are, you can even use smaller stop loss. So imagine that when you would normally take 1,000 stop loss, you can now take 500 stop loss, but trade two contracts. So your risk is the same, but the potential of your win, of your profit, is all of a sudden double. So there are definitely situations when your risk will be higher. There are definitely situations when you will get double stop loss hit. But in general, it's surprising. It's almost mind-boggling that more often you actually keep your risk or even lower your risk, which almost sounds counterintuitive.
Yeah.
But yeah, welcome to the world of trading, where everything is possible, and we always see some surprises, and that's one of the surprises that I keep seeing with dynamic position sizing.
Yeah. Yeah, that's often the case in trading, where the direct opposite of what you think is the way it works. So, we got an interesting question from Joshua here, just to clarify a little bit more. Let me put this one up on the screen. Joshua's got a lot of good questions today, so thanks, Joshua. So talking about this performance qualifiers a little bit more, the total strategy had a last end trades were losers, kind of like a filter, I guess, on there. So would you classify that as a performance qualifier?
No, that's first of all, it's binary. So it's just 0 or 1. Second, it doesn't assess the market. It doesn't work with the market condition. It only traces the dependency between trades. It tells you how much there's a dependency between winning and losing trades. So it's same way like looking on your equity curve, just from a different perspective. And as I said, we do not assess our equity curve. We don't care about this. We care about the market constellation. That's the market that tells us whether we will be on the higher or lower level of that probability range with the next upcoming trade.
Yep. Okay. We've got a few more questions in the chat. We're going to come back to them a little bit later. So I think now you've got a couple of slides prepared to demonstrate the kind of results you can get, or the expectations. So should we go through those, and you can talk a little bit about the the type of results you can see by using this approach.
Sure.
So let me get the slide up on the screen. One sec. Okay, so the next one. All right, so take it away. What are we looking at here?
I just took one of an older examples to demonstrate like the result of the application can really vary because sometimes you can have a fantastic, incredible improvement, which can be also what I need to explain. My objective is always to improve net profit drawdown ratio, because I believe that what every trader wants is making more money with a lower drawdown. That's all we want. Make as much as we can with a slow drawdown as possible. So that's why net profit versus drawdown ratio is the key metric for me, key element. And that's why I always aim for with these methods and improvements. And sometimes you can see just 5 or 10%, which doesn't sound much, but sometimes you can see 100, 130, 150% of improvement. So sometimes you can, get from 5 to 1 net profit drawdown ratio to 10 to 1 or 12 to 1. This is an example. This is before. We can go to after. I don't even remember which of these qualifiers it was, but I put a summary at the end. Like you can already see that we just improved the equity curve. It's a bit smoother. That's another side effect of dynamic position sizing. It can really help you smooth out your equity curves. But again, I'm not really that much. I rather smooth out my equity curve with portfolio. But this is more about the net profit drawdown ratio. And in this particular example, after one of these applications, the improvement was, if we can go to the next slide.
Yep, there we go.
Yeah, so here we can see, I just need to go closer. I don't see it well. So net profit, we improved 178%. Drawdown, we increased a little bit by 29%. So yes, sometimes we do, experience high risk, but on average, we jump from 4.3 net profit drawdown ratio to, is it 8.3 or 9.3?
Yeah,
9.3. It's almost 120%. Like show me any other technique how you can do this. Like show me how you can improve your net profit drawdown ratio by 120% without even touching your trading strategy's underlying logic. You can go to your trading strategy. You can apply 20,000 different filters. You can over optimize to that. Like you can really fine tune your backtest equity. So it will show you similar effect, similar result. But at the end of the day, all you're having is just overfit, over-optimize, over-filtered strategy. The beauty of dynamic position sizing is that first, you do not need to touch your underlying logic. You just put a layer of dynamic position on top of that. The second part, the second benefit of that is that it's very, very bulletproof to overfitting. I'm not saying it's guaranteed there will not be overfitting, because there's no such a guarantee in algorithmic trading. We can, whatever we do, even if we do our best, we can sometimes overfit. But this technique, if well used, well applied, the risk of overfitting, it's pretty low. And with very low risk of overfitting, you can achieve such a huge improvement very fast, literally sometimes in a couple of minutes. Show me any other way how you can achieve that. I'm not aware of any other way how to achieve that than playing smartly with position sizing.
Yeah, I guess as well. Excuse me. I guess as well, the when you start adding filters into a trading strategy, you're really reducing the sample size, right? Because you're trying to filter out the poorer quality trades. So I think that's one of the dangers of using filtering and overfitting, is it can actually have a negative impact, even though you think you're improving the strategy. So DPS doesn't do this, right?
No, you do not touch your sample size. It's still the same. You do nothing with the underlying strategy. You just put DPS as an additional layer on top of that. So you cannot do any harm to your strategy.
Yep. Now, you've been talking about contracts because you're a futures trader. Does this work for other markets like stocks and ETFs or whatever?
Absolutely. Yep. You can use this for stock markets. Instead of contracts, you will be using different shares. So you can have your base can be 100 shares. In better scenario, in high probability scenario, you double to 200 shares, or you cut to 0 shares or 50 shares. You can use this on Forex, just use different number of lots. You can use this on CFDs. You can use this on ETFs. You can use this on cryptocurrency trading. You can use this on anything. It's very universal.
And what about for traders who have small accounts? Because obviously there's margin requirements if you're trading futures. So can it be applied to futures traders with smaller accounts?
Yeah, as far as you can handle only 2 contracts, that's the minimum you need to be able to handle with your account, considering margin requirements. You can apply it immediately, because it only makes sense if you have enough money to trade at least 2 contracts, because you can trade 0, 1, or 2. On average, you're 1 all the time, but you need to have enough money to cover at least 2 contracts in margins.
Yep. What about traders who trade, say, 10 contracts?
Oh, fantastic. Fantastic. If you take 10 contracts, then dynamic position sizing will tell you when to cut it down to 5 and when to increase it up to 15. And it's the same principle. This works for beginners. This works for advanced traders. This works for hedge funds, obviously. So this is very universal. All it requires is just to open your mind, step out of this dogma of typical position sizing, step out of this old-fashioned view of applying statistic on equity curve and analyzing trade dependencies, and just open mind to something new, which is really based on rather than on equity assessment, is based on market assessment, market regimes assessment, volatility assessment, and it's something new. A lot of traders are quite conservative and they are afraid of new things. And I think that's a shame, that's a pity, because that's one of the things where you can really, with stuff like that, when you open your mind to something new, you can see incredible improvements in a very, very short time without high risk of overfitting.
Yeah. Okay. So I've got a question here in the chat from Rogerio. Hey, Rogerio, good to see you.
Hey, Rogerio, nice to see you.
Let's put this up on the screen. Do you trade any systems with market internals and DPS applied at the same time, or is it too much to have both of them?
I would say I'm not a big fan of layering these techniques, but you can definitely do, because you can use market internals as a DPS performance qualifier. So one of the DPS techniques we use is market internals itself. So instead of using market internals as a filter, you use them as a qualifier to change your the number of your your position, or the number of your contracts. I'm not a big fan of putting too many layers, too many techniques together. But definitely definitely market internals can be used as a performance qualifier quite reliably.
Okay, and we got a question here from Amir. Let me get this up on the screen. Tom, have you made any relation to optimal F position sizing by Rolf Vince? If yes, what are the similarities or differences?
This is a completely different thing. It's got nothing to do. It's got nothing to do with the F. By the way, I think that the optimal F is quite aggressive approach. I never used it. But this again, what I would like to ask you guys is just to step out of these very, very, very old techniques. This is something new. Now you're really stepping out to modern way of position sizing. You're getting out of this box of techniques that been used for ages. And you know, I don't want to say they're obsolete, but I think it's time to go beyond them. Because we're now living in times where we have so much computing power, so much smart people in trading, that we can really come up with something better. And, you know, for a long time, we haven't had anyone like Larry Williams who would be willing to come up with a different idea or different approach. So the industry is a little bit frozen when it comes to position sizing. Yeah, I think in a way these are obsolete techniques. Now you can take dynamic position sizing and combine them with, let's say, fixed fraction or with these older techniques, because once you have established 2 or 3 different levels, you can also change percentage instead of certain number of contracts, and that percentage of capital will dictate the number of contracts. But this is something completely different. This is something new. And again, it needs some courage. It needs some willingness to step out of these old-fashioned concepts, obsolete concepts, and just try something very different, very new, and I believe way more efficient, way more efficient.
Yeah. All right. Thank you. Amir says thanks. Great question, Amir. Thanks for that one.
Good question. Thank you.
Another question here from Joshua. I like the way Joshua thinks. Let me put this one up on the screen. Joshua has already figured out how to implement this. Could you use DPS as a function to be called in the strategy code?
Oh, yeah. Good question, Joshua. Yeah, exactly. Yeah, absolutely. Absolutely. You could.
Yeah. So, well, that kind of leads into a broader question on how do people get started with these techniques if they want to, start applying these to their own strategies. So, do you have any tips for that?
I do. So I have a great news for you because Andrew helped me to put together an ebook that explains, including some code and examples. So there's an ebook which will help you to go deeper into this concept. We will show and share some specific code, specific application, so it goes into practicalities. And we put this ebook together with Andrew this week. And I don't know, Andrew, if you have the link there and you can show where they can download it. It's free. It's completely for free.
Yeah, I don't have it actually to put up on the screen, but I will put it below the video here. But the URL is, I've got it here in my notes, dpstradingtechnique.com. So dpstradingtechnique.com. I'll put a link below the video here. I don't have it to put on the screen. Sorry, I didn't prepare for that. So go on. Sorry.
Guys, you can go to dpstradingtechnique.com. DPS Trading Technique, like one sentence without any dashes or interruption. dpstradingtechnique.com, and you can download a free ebook.
Yep. Okay. All right. Well, we're going to start wrapping up here in a minute. I just want to search through the chat quickly because we've had some comments, and I just want to make sure we don't miss anyone's questions. So if you've got a final question, please post them in the chat very quickly. I think we've got them all. So, Thomas, any final questions or comments, statements before we finish up today?
I'm looking forward to questions if there are any to answer.
Looks like we've answered all the questions, unless I've missed.
We did. Okay, so, great.
Yeah.
Well, I think the best way I can, the best next thing I can recommend is just download the ebook, dpstradingtechnique.com, and please be open. Like really in trading, one of the most challenging things in trading is have this willingness and courage to step out of these old-fashioned concepts that's been here for 50, 60, 70 years and start working with something new, because that's where the money is. Have a look on companies like BlackRock, and these companies are investing billions and billions into research, and they're making money because they're coming up with new things, not because they keep using 70 years old techniques. And really don't be afraid to step out, think differently, and start changing your position size, not on all these obsolete techniques, but really on the context of market. That's what I believe is the most important thing, to take market regime, market context into consideration when you want to start position sizing, because what could also happen is that you start position sizing just because your biggest drawdown ever, and then you will cry over this split milk. And then I would also encourage even beginning traders to start thinking about trading between 0 and 2 contracts as a viable option. On average, 1 contract, but you can have enormous improvement of your performance, more money with same or just a little bit bigger or even sometimes smaller drawdown, just because of this variability between 0 and 2. So there's nothing to lose. There's a lot to gain. So why not, start thinking this way and just see what you can figure out and come up with, or maybe the ebook will serve you, and open your mind and try something different, because that's where I constantly see the money is, in something new, in unexplored areas, in new and fresh thinking, fresh approaches. So that's all.
Yep. Okay. Excellent. One final question, I think, from Thomas here. Thomas, g'day. I haven't seen your name here before, so welcome. If this is your first time, is that only for easy language or also for MQL4 in the ebook? The examples.
The ebook explains the example in easy language only, but the dynamic position sizing is absolutely I'm not saying easy because I'm not coding in different languages, but should be absolutely easy to apply it in any platform. Like I cannot see any reason. I could honestly apply position sizing in my Excel spreadsheet. It's just a matter of writing the right functions or right syntaxes in Excel spreadsheet. But I could easily do it in Excel spreadsheet, so it can be coded in anything.
Yeah. Okay. I was just about to wrap it up, but a question here from Amir come up. Let me put this on the screen and then we'll finish up after this one. I know I said that before, but I promise. I'm curious about the quantification of pre-qualifiers, but didn't quite understand if they are proprietary or available in the ebook.
Well, most of them are proprietary, but the ebook explains at least one, and it will give you a very clear idea how it works and how we code it, and there's quite a lot revealed in the ebook already.
Yeah.
Conceptually. Then you of course need to think a little bit and test your own stuff on top of what is in the ebook, but there's quite a strong pointer how to do that. Yeah.
Actually, we've got a comment here from Gus. Thank you. Already thinking how to implement it. So good work, Gus.
Great,
and I know Joshua is as well. I can tell by his question. So, and Amir says thank you. So, thanks for your time today, Thomas. I appreciate you sharing this technique. I think it's super powerful, and everyone should go and check out that ebook and look at the concept and think about how they can apply it to their own trading. And then, thanks everybody for joining us today. We had a great group and some excellent questions. So, it was great. Let's put a couple of comments up on the screen to finish up. And while we're doing this, please don't forget to hit like on the video and subscribe so that you don't miss any of our future content. So there's one from Joshua. Thanks, guys. We got one here from Amir. Thank you. Thomas says thanks. We got G Heim. So lots of thank you. Oh, here we go. We've got a couple more. Let me put them on the screen. Finish on a high note. Sanan, thank you for the question earlier, Sanan. So thanks a lot for your time today. Again, Thomas, we got some more coming through here.
Thank you very much for having me. It was a pleasure, and thank you very much for such a great audience. Great questions and a lot of feedbacks and responses. So that was a joy to be here. So thank you very much for this opportunity.
Yep. Okay. Excellent. Raphael says thanks. Reading the PDF already. So wow. That's
great. Great. That's some serious action taker. I like that.
Yeah, that's great. That's great. Don't leave it till later because you might forget. So, all right. Thanks again, Thomas. And thanks for everyone for attending today. And we'll see you next week at, I think we're back to the normal time, 7 p.m. US Central. So thanks again and have a great week. Cheers, everyone.
Thank you. Bye-bye.
Okay, bye.